Everybody. Today we're going to be talking about Google, and we're going to be talking about where they potentially could be going after their earnings report. So we're going to be talking about a couple things here. First thing we're going to be talking about is running them through my high five trading strategy setup. The next thing we're going to be talking about is going to be running them through my valuation metric tool that I built, and which I actually have a 6 for 6 score on. And then finally, we're going to be talking about this head and shoulders pattern and probable moves for earnings. So let's get into it. So my high five trading strategy essentially consists of 5 key indicators. This is something that I've personally built, and it has consistently worked for me on my trading journey. So the first indicator is going to be some sort of pattern, some sort of charting pattern. And as we can see, we have a left shoulder, right shoulder, and a head for your inverse head and shoulders here. And the second indicator is going to be a volume gap of some sort. So using the volume weighted profile over here, we have a volume gap to the upside and a volume gap to the downside. And we're going to talk about these red and green lines here in a second. So check mark on 1, check mark on 2. Number 3 is going to be your MACD. The MACD is kind of in this like bull flag pattern on your MACD, and we have not crossed blue over orange into a bullish uptrend yet. So I cannot count that as it is not there yet. Another reason we are only 3 of 5, and the next indicator on my trading setup is going to be your RSI. The RSI is in a symmetrical triangle. It's kind of just bouncing around. It is in a bullish uptrend, purple over yellow, but again, we are in this trend sideways. And as you can already notice with this chart, we are in a trend sideways in a consolidation leading up to earnings. The MACD is not telling us really a direction. The RSI is not really telling us a direction. We're sitting on this volume shelf. We could fly up or we could fall down. There's gaps to both ends. So, and the last indicator, which is going positive in Google's direction, is going to be your trend or your stochastic indicator. We have moved up into the sweet spot, red over yellow, bullish indicator, and but we are getting closer. The wider the gap between your red line and your yellow line, the more bullish it is. Especially you want that gap to be as far apart as possible moving into the sweet spot, because that'll essentially tell you, hey, I'm going through here and my red line's coming up here and my yellow line's down here. We got a big gap here, and essentially that's going to bode well for you. And it just kind of gives you a more bullish indicator. When you're moving up through and you see this and it's coming down and it's getting tight in here, well, that's going to be where you have to look at your other indicators, right? So it's getting tight in here on the stochastic and the trend, but here we are in a symmetrical triangle. Don't know which way we're going to break out. We're in a MACD that hasn't crossed upwards. We are above the zero line, but we're in a falling wedge or a falling or in a bull flag we could be. And we're also sitting on a volume shelf that could go either way. The indicator is the inverse head and shoulders, but again, I'm counting that because it is a charting pattern that we have. But typically I would like a breakout of that charting pattern, which the breakout would come at about 170.68 on this. So the expected move for Google after they report earnings on Tuesday is going to be a 6% move, up or down. So this is what they're expecting through options play, and it kind of lines up perfectly, doesn't it? We have a 6% from the current price upward to the next volume shelf and filling this volume gap, 6%, or we would have a 6% down filling this volume gap here. So it's kind of funny how everything kind of aligns when you're really looking at the charts. And a big thing to understand is like charting and all of this, it's all in probabilities. The more things you have going on your side with the probabilities, the more likely you are going to be right. You're not going to be right every time. You're not going to bet 1,000%. That's just not how this game works. So, but you want to get as many probabilities on your side, which is why I created the high five setup that I personally created, back tested, and used, and it's very successful. 80% plus win rate I've had on this strategy. So this is kind of what I'm looking at these charts. And if we did break out of this head and shoulders here, we are looking at a move upward to about 193, we'll call it, for your move up after the head and shoulders breakout. Another thing I wanted to bring to the attention before we get into my discounted free cash flow valuation metric tool is that on the weekly here on Google, it's kind of funny. So I measured these moves out. So we had from the bottom of 2020, we had a 10,205 bar move upward before we peaked and then came down 6,837 bars. And then right at that bottom, we had another 10,205 almost. We're a little bit off here, but dang near the same amount of move. Is history going to repeat itself is what I'm asking, because we had a 6,837 bar drawdown, and we are right here. We got to about over halfway through it, and then we bounced back. Are we going to continue down to at least here at 131, 132 to this volume gap shelf? Because you can see here on the weekly, we're sitting on this volume gap here as well. It's kind of the same thing as the daily. We have a move up here, or we have a massive move back down here to retest your 132, 131 price target. So I wanted to bring this up as well because I think it's important. Looking at this, history does repeat itself. This could just be a similarity, and it doesn't happen again, right? And we just bounce and continue to go higher, especially if they have great earnings and stuff. But we do know that Google has a lot of, I would say they have a lot of roadblocks in their way right now. Their business is great, but they have a lot of roadblocks in the sense of the DOJ going after them, possibly trying to split them up. All the rumors about that. It doesn't help that they had employees on TikTok showing that they didn't do absolutely anything. So this is kind of what I'm seeing here. And yeah, so now that we looked at the 5 for 5 trade setup, the high five setup, we see that it was a 3 for 5. And, it's not quite there meeting my criteria for an entry price. So I'm personally going to back off and stay off of this name going into earnings on a trading standpoint. But we can talk about it on an investing standpoint. And if we're talking about it on an investing standpoint, this name's a buy. This name's a buy all day. Why is it a buy all day? As we can see here through my discounted free cash flow yield, price to earnings, and PEG valuation metric. Yeah, I need to find a shorter name, I know. But basically, as we could see here, right, at taking a forward free cash flow rate for the next 5 years of 19%, which they're doing that right now, and then doing moving up to a 24% free cash flow margin rate for the last 5 years of this 10-year analysis, giving them a terminal value, which is basically assigning them just like a PE, assigning them a free cash flow multiple at the end of the 10-year mark, so in 2033, of a 25. And I'm doing that because it's Google. I mean, we don't know what's going to happen in 10 years, but it's Google, and I'd probably give them a 25 because they're going to be a Goliath still. They'll find other industries to grow in, and the world's only getting bigger, in my opinion. But we plug in all our numbers here, and so there's a lot of numbers, I know. I'm just going to focus on the main things, the numbers that my valuation metric really spits out at me and shows me, hey, is this thing a buy or not? So right down here, we have our valuation score. I have the high five strategy for trading. For investing, I have the valuation score up to 6. I haven't found a name for it yet, but the high 6 maybe, I don't know. But essentially, what the valuation score, the 6 valuation scores and criteria I look at are going to be your free cash flow yield for the current year, your forward free cash flow yield. So above a 3 is solid. That's what we want. That means we are getting solid cash flow back through the company into our pockets as shareholders. And then we have our PE and our forward PE. So our current PE under 25, I think that's great. 20, it's almost a 22 for Google. You're getting YouTube. You're getting the two largest search engines in the world. You got Google and YouTube. They are number one in ads. Like for a 22 PE, I mean that's just a steal of a deal, and that's why I was talking about, and I want you guys to answer in the comments below. Is this name is this Mag 7 name finally going to play catch up to the rest, because they have lagged behind greatly to all the other Mag 7 names, especially with Tesla's big run now. Our forward PE based off our EPS here is going to be a 19.2. Again, anything under 25 I think is really good. Anything above 25 to say 30 is probably mid tier, but it all depends on the growth rates too. So, and then we have our price to earnings growth. So our PEG ratio, we had a 33.5% increase in our EPS year over year. So that brings our PEG ratio to 0.65. Anything below 1 is great. Anything above 1 is okay. And then anything above 2 is a little bit pricey. So we have 1, 2, 3, 4, 5, and 6. So 6 right here. We have our intrinsic value. This is spat out through our revenue growth numbers here. So we have our revenue growth numbers here, 13%, and then dropping down slowly as we go. Sorry about my dogs if you can hear them. Yeah, they bark at everything. But so we have our revenue growth rate, and we consistently drop it down over the years as they continue to go down, and the valuation or the revenue growth slows with such a Goliath of a company, getting to 798 million by 2033, and essentially you have your intrinsic value that spits out at $209, which is a 20% current margin of safety on this company, and a 6 for 6 all around. So on an investing standpoint, I'm a buyer, I'm a shareholder, and I continue to buy going into earnings. And if this thing dips down that 6% like we were talking about, I will continue to buy more heavily as we keep going down, because if we get down to that 130, we're looking at about a 30 to 40% margin of safety. And that's just phenomenal for what you're getting in this company. So I'm honestly, again, not playing it on a trading standpoint. I'm honestly hoping for a dip down in Google so I could buy them for 30 to 40% margin of safety, because I just think this company, it's worth $209, and it's going to be worth a whole lot more in the future. So that's my high five setup, and that's my valuation metric tool that looking at Google. So you got a 2-for-1 today. We talked about investing, and we talked about the trading setup. So I guess we will see what happens to Google going in, after earnings. They're expected to report pretty good earnings, so we will see. But if you made it this far in the video, I know it's a little bit longer than normal. I just wanted to be thorough with this company because it's such a Goliath and a mega cap. So I really appreciate it if you did make it this long in the video. I hope you continue to have a great weekend, and drop a comment below if you think and what you think the stock's going to do after earnings. Thanks, everybody. Have a great day.